This is our currency index for May 24th, 2013. And basically what it lets you see is at a glance what each currency's trend is, where it's likely to go to, and there's many patterns that show either continuation, in other words, the trend will continue, or very high probability reversal. And so that's one of our best tools. And I like to show it in the blog every day because it's the easiest way to trade. If you see, for example, the euro, whose daily and weekly trend is up, go from underneath its hourly moving average to above, it's going to tend to go up. If it is going sideways in a nice rectangle pattern for 2 hours, that means across the majority of euro pairs, it's just not going up and not going down. It's clearly above its hourly. It's above its point of control the previous day, which is the price most traders have positions, which means you know ahead of time that in most euro pairs, traders who were short yesterday are losing money because it's above that price. Anyone who shorted it yesterday, the most actively traded price short was right here. So they're down quite a bit. When it breaks the previous day's high and it goes and it becomes stronger than it was all day yesterday, that's a trend that's likely to continue, even if it's only for an hour and 10 minutes, as you can see. So that being said, what do? Well, you just simply want to look to buy the strongest currencies versus the weakest. You can see the Australian's weak, the New Zealand's weak, the CAD breaks down right here. And so those are some of the easier ones to trade. Now you can pick many different ways of trading them, but the point of using our currency index not only is to anticipate future price moves, which it does many times with very high degree of accuracy, but more importantly, it's to help identify which currencies to trade. In fact, one method that I trade frequently, if I only have to scalp, is that if one currency hits its lower Bollinger Band and the trend's down, it's underneath its hourly, and another one hits its upper Bollinger Band, you want to buy the strong one versus the weak. Or, so in this case, it would be selling the Australian dollar here, coming up to 4. You can do that on any time frame chart, tick chart, range chart. Range charts is some certain number of pips per bar, and of course, minute-based charts, 3-minute charts, 5 minutes. Some traders use and love 2-minute charts that are pretty much scalpers. So let's take a look at some of those charts and show how once you identify the right trend, getting in and out is the easy part. I'm going to focus on buying the euro because its trend is up, the point of control, it's above the hourly, it's right near the previous day's high, which means if it breaks, a lot of stops are going to get hit, adding further fuel to the up move. And so let's take a look at buying this versus clearly the weakest one on the chart, which is the Australian. The daily trend is just blood red. The weekly trend is blood red. The CAD is also super weak on the weekly, but not quite as weak here. So whether it's Euro Australian or Euro CAD, those are the two highest probability trades. So let's take that off the chart and just bring up some charts to help you know when to get in and out. It doesn't, like I said before, the time frame doesn't matter. We also have a slew of other tools that can help you. You can, in this case, use a 5-minute chart. You could change that to 5 pips per bar range chart, which gets rid of a lot of the noise. Every time it moves 5 pips, it goes up or down, but there's 1 bar. And so during actively big moves, you can see the 2 moves, how they look in comparison. Very few number of bars because it happened in a short amount of time. Considerable number of bars. In fact, there's 1, 2, 3, 4, 5, 6 bars that went up, and here there's considerably more, maybe 3 times that many. So whether you're a scalper or a longer term trader, determines what size time frame you trade. But if you're a longer term trader and you see that the Euro Australian 5 pips per bar range chart, and you know that it's trending up, you get this little 3-bar pullback with 1 bar going up. You also have a wick here, which is oftentimes a signal of reversals. Wicks oftentimes after many bars up or many bars down. 3 is the minimum I would consider using a wick. You can see it's higher high and it closes down. Wicks tend to be big predictors with range charts. That's one of the reasons why I would say if I had to pick one time frame, I like range bars. And I can also adjust the number of pips per bar based on each currency's volatility. If one currency moves 200 pips a day, I could use a 7 to 9 or even 10 pip per bar range chart. If a currency moves 50 pips a day, I could use a 3 pips per bar. So you keep the stop. I like to keep the stop right underneath the swing low. I like to buy when it goes 1 pip above the high. And the whole point of trading, the only secret of trading is to have small losses when wrong. And so this is your loss if you're wrong. You put your stop a pip underneath the low. And you can see that if you just simply trailed your stop, all right, it goes up, comes down, goes up, comes down, move your stop up, goes up, comes down, move your stop up. And, you know, once it hits a certain threshold, you're up 20 pips at this point. I tend to just draw kind of a trend line underneath those bars and get out, because the farther up it goes, the more likely it's going to pull back a more considerable amount, so don't be greedy. So you, in this case, if you got out when it broke that red bar's low right there, this is how much you made versus the tiny risk. And so once you identify currencies that are likely to trend, and when they start moving, you get in, you're already up money. Now, where do you move your stop to break even? Well, for me, the initial stop's here. Once it kind of goes up 1 or 2 5 pips per bar range charts, I'm moving my stop to break even. A lot of times I'll exit anywhere from a quarter to half my trade. If it was at the upper containment band, I'd probably exit 50 to 70% of the trade and trail 30 to 50% of the rest. If the containment bands are way up here, I would expect a strong trend to reach those, so I would exit maybe 20 to 30 or maybe 35-40% of my trade and keep the majority of it. So it's just common sense stuff. Trading is not complicated. What is the smartest thing to do is a good question to ask yourself, and try to do that. Now, another type of chart you could use that also would help you in trading, especially if you're a short-term trader and you want to get in and out, in and out, and in and out, and you want to have more wins and losses, is a tick chart. And, you know, I use anywhere from 30 to 50 T. You got to put a T at the end, hit enter, and it's going to download all the tick data and create the bars. Let's scroll back to that time. You know, around 4 o'clock, you can see there's a ton of bars on here because each bar is just simply 50 price changes. So the more active the market is, the more bars there are. And you can see at a very quick glance why I prefer the range charts than this, because you really can't see as much time on the tick chart as you can a range chart. I mean, if you notice the difference from 3:30 to 4, it's a big difference. From 3:30 to 4 on here, that's a lot fewer bars. Now, obviously, on a 5-minute chart, there would be 6 bars from 3:30 to 4. And one way of remedying that is to, if there's too many bars in the chart, you can go from a 30 ticks per bar to, you know, maybe 60 ticks, and that would give you fewer bars because there's more ticks per bar. But let's go back to the 4 o'clock time again. This looks a lot better to me. You know, there's, you know, anytime a market kind of goes up and goes sideways in a nice little rectangle pattern, the breakouts are very high probability. Again, you would buy the breakout. And I like to see rectangle patterns where it tries to break out, comes back down, never goes back through the low. The second time up through, it's very high probability because traders are kind of expecting it to come down. When it doesn't, they all scramble and exit. So your stop is here, kind of goes up, pulls back, you move your stop up. And you can see on the ticks bar also, it's a pretty high probability place. And you can also buy this little pullback if you really believe it's going to continue. Maybe get out of half your trade here, goes up again. You can draw your fibs on tick charts and range charts very nicely. Notice, hit that fib target to the pip. You know, don't be greedy. If I have my whole position on it, hits the fib target and kind of stalls, I always usually get out of half. If I have a very small percentage of it left, I will also tend to exit at least half of what I have left, or if not all. Most of the time I'll exit all of it. But that's, you know, these are some of the ways you can trade once you've identified which currencies are going up and which ones are going down. Let's take a look at just the top 4 pairs that most people trade. Clearly the euro is strong. You can also see that the dollar attempts to go above the hourly a few times, fails, false breakout up, comes back down. Very high probability at 4 to sell the dollar. At 4 is when the euro explodes up. So at 4 o'clock, you definitely want to be buying the euro dollar. It's a no-brainer. You're going to make money with this trade most of the time. Let's take a look at the euro dollar at 4 o'clock. And we'll go to a 5 pips per bar range chart at 4 o'clock also. Again, look at the increased clarity with the range chart. You know, if you missed that breakout here in the 4 o'clock, it gapped up. So you would have probably not been able to buy it right here on a 5-minute chart. So you have increased clarity on a range chart, because if price gaps, you don't see it. You know, anytime there's a blank hole, price never traded at that price. Now, I don't like to buy gaps. I would much prefer a gap up and it's kind of going sideways, and I would, you know, buy this little breakout right here with my stop underneath here. Or if you want to be a little bit more careful, put a rectangle on here and buy the breakout with a little bit wider stop, which means you have to trade smaller lot sizes. And once you do that, you can draw your fibs off of this wave from here, and I would do it all the way back to the low. And you can see it shot through the first fib targets, kind of going sideways. I would exit half the trade here, and when it goes sideways here, I move my stop underneath here. Comes up real close to the 1.618, I'm out. You know, depending on how much time this goes by, it's 30 or 40 minutes. More than likely, knowing myself, I would have probably got out of half the trade here and part of it here when it goes sideways, and just miss this last few amount. Now, strong trends tend to continue, and there's nothing better than buying a pullback. And so with this, anywhere from 3 to 5 pips, or 3 to 5 red bars down, first red bar, green bar up, you buy, you put your stop here, put your stop underneath the low. It's possible you would have got stopped out depending on if you put it a little wider here. Again, you can also wait for a rectangle box to break out, and you can see it's going up. And a lot of times markets don't break the high. You have divergence at the high. Now let's take a look at this same chart with tick chart. I think it's underneath here. There we go. So we will get a tick chart and look at it from 4 to 5 or so, and also this 530 pullback. Now obviously there's a ton of bars on here, even with 60 pips per bar. So it doesn't let you see as far back. You don't know if this price has been trending down for 5 hours here, or if it's been going up and going sideways. And that's one of the reasons why I will occasionally look at tick charts, especially if I have a big position and I'm, you know, for lack of a better term, a little bit nervous or scared. Everyone gets scared, you know, especially when you sometimes trade lots bigger than your comfort zone. But, you know, if I was using this tick chart, exploded up, pulled back, I would kind of want to buy this here with my stop underneath here, and it's just going sideways. I'd be really nervous right here. As soon as, you know, it goes up and down twice, I'm moving my stop up underneath here, because I want to lose a very tiny amount here. And then it explodes up, and there's real no reason to get out of it. You keep moving your stop up. I would have probably got out a little bit on this pullback. It came up here again. I put my stop underneath here and get out. And you can see a very nice win. But I think it's much preferable on the range chart. You're in. It's just bar, bar, bar up. There's no red bars at all until right here. It's just easier on a range chart, in my opinion. And you can use, like I said, any time frame one you want. If you're a longer term trader, you know, maybe a 10 pips per bar range chart. So guess what? You can see back 2 whole days now. And you can also, you know, because you can see back 2 full days, you draw your fibs on there. And while it didn't hit the 1.382 fib target, it is at the first one right here to the pip. I think it's 1.27 something. It's one of the odd fib things that we put in there because traders wanted them. And, you know, when the market's gone a good distance, it's less likely to hit the normal fib targets. These become more possible, you know, as likely to be. And of course, with this, you got a nice 10, 20, well, 10 plus 5 plus 10, 25, maybe, because this one started to go up then came down. You got about 30 plus pip pullback right here. You can get long with your stop underneath the low. And the fact that it didn't take out and stay above the high here, a lot of times double tops are the end of the move. So if it goes above there and then dips its head back down, you get out and you make 10, 15 pips or 20 pips. Now with a 10 pips per bar chart, you're risking more pips because if you're using that approach of waiting for 3 to 5 bar pullback, 1 bar green, you buy it when it goes 1 pip above here, you're risking now 10 pips plus 1 or 2 pips padding plus the spread. It's a much bigger risk. It's more than double the risk than even a 4 or 5 pips per bar range chart is. So, but everyone needs to find what makes sense to them. There's fewer trades on the 10 pips per bar range chart, but there's probably a higher winning percentage. Anytime you get an up down a couple times, those breakouts tend to work. Then you broke out here, it went up down again. You have another one here, broke out. You have an up down up bar pattern. These tend to be signs of decent sized moves coming after here. Here you got an up down pattern, breaks out and it continues down a considerable distance. You have an up down pattern, one more up. When it breaks out of here, it continues up another 20 or so pips. You got the up down pattern right here, and it continues down for another 15 or 20. Making 15 or 20 sure beats what most people do, is taking 3 to 5 pips win and losing 15 to 20 pips when they're wrong. Most people have big losses and small wins, which is exactly the opposite of what you want to do. So I can't answer the question for you. You got to find out what time frame chart works best for you. It could be a 1-minute chart, 2-minute chart, tick chart if you really like to get in and out. I think tick charts jig me out of the trade way too soon, and I make way less than I do using range charts. So I would recommend using range charts over tick, but it's up to you, and you got to decide the time frame that works best for you. It could be a 10 pips per bar range chart, 5, or even if you want 3. You can put a 3 pips per bar range chart on this if you want to scalp. Let's take a look at that move up on here. You have a nice little kind of volatility wedge pattern where it exploded up. It's getting less and less volatility. It had every opportunity to break out. Anytime trend lines get hit 3 times, 1, 2, 3 to the downside, 1, 2, 3 to the upside, a breakout is very high probability. This is just a phenomenal pattern, and you might not have seen this on a 5 pips per bar range chart, and your risk is less because you're using 3 pips per bar versus 5, a little bit less. I mean, it's just phenomenal. You might also say, I want to get out of half my trade here and half here with the next bars. Or you can say, when 2 bars happen, I'm going to get out. So this would be where you got out of the trade. I mean, there's so many ways to trade. It doesn't matter. Small losses, big wins. Risk a tiny amount of your account on any one trade. That's it. Simple.